I've got to ask you though, because all things aren't equal, I would imagine that if we were to see the Fed cutting rates as you're suggesting on that kind of a timeline, do you imagine that the Eurozone wouldn't have already gotten there first? Because what we're seeing right now is, I suppose, far deeper problems in the Eurozone vis-a-vis the United States in terms of the macroeconomic picture, and they're not geared for tolerating higher rates like a lot of the corporates in the US are, or like households are. So do you think that we are going to see the ECB being able to maintain higher rates if the US begins cutting because of the economic conditions there?
Well, that's a discussion that's been happening right now, to be frank. And of course, Christine Lagarde is decidedly more hawkish in a sense at Jackson Hole compared to Jay Powell. Now, having said that, this is all about interest rate differential. You notice that the moves over the past month in the FX space is predominantly driven by interest rate differentials. Dollar yen, for example, dollar renminbi, for example. It's all simply because the interest rate differential are moving strongly for the dollar. And I guess, in a sense, if you expect that the ECB can be still marginally more hawkish than, the Federal Reserve in the months ahead, because they still need to contain the inflation issue. So on that balance, we would expect the euro to start to bottom out a little bit against the dollar. Having said that, Will, I do agree with you that from a longer-term macro dynamics, there are worries about the Eurozone economy.
If we see the data from the US, the jobless numbers, the GDP numbers coming in strong, is that going to push back your expectations a little bit?
Well, I think it's pretty much a done deal that, the data we see this week from the US will, be strong as expected. For example, we would expect the second reading of the US GDP to be around 2.4%. That's reasonably strong. And we would expect, core PCE to stay strong around the 4.4%, so on and so forth. So all this has been well communicated by Jay Powell at, Jackson Hole. He has said two things. He has said that, inflation is still a concern, and he has said that growth is stronger than expected for the US economy. So we should see that reflected. I would say that's priced in for financial markets at this stage.
What are your expectation on, or what is your expectation on duration? Because, what we're seeing right now with the 10-year, there's a multitude of factors at play. You've got this issuance that's coming on thick and fast, even though there is a requisitely high level of demand, it seems, at the very least, in terms of the auctions we had this week. But I would imagine that with the increased issuance and the expectation that increased issuance is going to be here to stay, considering the debt that the US government is currently facing, and then you've got sovereigns that are looking to sell down duration because of their own currency concerns, like China, like Japan. Do you not think that, even with everything else, that the US dollar just continues to catch a bid?
So the thing with duration is this. It is true that markets were caught off guard, by this rising long-term bond yield in the back end, as you say. The Treasury refunding, the quarterly issuance has been much more stronger than initially anticipated. Now, what's interesting is this. In my recent conversations with the various asset managers, this topic has crept up. And basically how everybody's trying to manage this is you're trying to move away from the longer bucket, let's say from the 10-year, into the much more manageable 5 to 10-year bucket. I would say it is a tactical move just to contain the risk and to ring fence, the tail risk for the rest of this year. But eventually, by the end of the year, once, the market has got used to this new pace of issuance from the US Treasury, and once the market starts to derive, benefits from the higher yield that we're seeing over the past few months, I suspect, this duration concern will be much more manageable as investors push back up to the longer end.